Welcome to our channel, Finance Experts. Now let's consider what are credit scores, how to have a secure credit score, how to measure your credit score, and how it will involve your finances. If you want to get authorized for loans, credit cards, or home loans, you must have a high credit score. It is a numerical indicator of your creditworthiness that lenders use to assess your propensity to make timely loan payments. It's critical to pay your payments on time, maintain a modest credit card balance, and refrain from opening too many financial accounts at once in order to maintain a high credit score. Making wise financial decisions requires having a solid understanding of how credit ratings function and how they may affect your financial future. One of the most significant financial indications used by lenders to assess your creditworthiness is your credit score. A high credit score might result in better credit card offers, lower loan interest rates, and increased credit limits. However, a low credit score might make it challenging to acquire credit accepted and result in higher interest rates and costs. This video will go through what a credit score is, how it is determined, and how to raise it. It's an indication of your likelihood of making timely debt payments. Your credit score might serve as a sign of your reliability and financial responsibility to potential employers, landlords, including lenders. A credit score. What is it? Your creditworthiness is shown by a 3-digit number called a credit score. The FICO score, which is available in a range of 300 to 850, is the most popular credit score. Lenders will view you as more creditworthy if your score is better. Generally speaking, a credit score of 700 or more is regarded to be excellent. How do you determine your credit score then? Experian, Equifax, and TransUnion are just a few of the credit reporting companies that determine credit ratings. Each of these organizations allow you to request a free copy of your credit report once per year, which will give you a good sense of your credit score. Exactly how is a credit score determined? Your payment history, credit utilization, length of credit history, categories of credit, as well as new credit are some of the variables used to create credit scores. Although the particular algorithm used to determine your credit score is not made public, the following elements typically have the greatest impact. Payment history, which makes up 35% of your FICO score, is based on how frequently you've missed payments or defaulted on your debts, as well as whether you've paid your bills on time in the past. The payments you make on credit cards, retail accounts, installment loans, finance business accounts, and mortgages are all included in this component. Also taken into account are open documents and reports describing things like bankruptcies, foreclosures, lawsuits, liens, judgments, and wage garnishments. Your score is impacted by a history of timely payments of at least the minimum amount required. Missed or late payments lower your rating. Credit utilization. 30% of your FICO score depends on your credit utilization, which measures the amount of available credit you are really utilizing. You should aim to keep the amount of credit card you use at or below 30%. Displays your level of debt and helps determine whether you can manage what you owe. Your credit score will suffer if you have large outstanding balances or are close to reaching the maximum limit on your credit cards. A decent rule of thumb is to not use more than 30% of a credit card's available credit. An installment loan's repayment is viewed favorably. Your payment history thus far displays responsible debt management, which positively influences your credit score. Length of credit history. Based on how long you have had credit card accounts, this factor contributes 50% to your FICO score. In general, your score rises with the length of your credit history, how much credit you've had and used throughout time. Because lenders have a better chance of observing your payback record, the longer you have demonstrated appropriate credit management, the better your score will be. If you have consistently made payments on time, you will seem very excellent in this regard. Credit account types. This category, which makes up 10% of your FICO score, is based on the credit accounts you have, such as credit cards, auto loans, and mortgages. This relates to the mix of credit you have. Not every sort of account is required. Instead, this component looks at the different sorts of credit that you have and how responsibly you use it. For instance, using a credit card to buy a boat can lower your rating. New credit. This category, which makes up 10% of your FICO score, is determined by the frequency with which you open new credit accounts. Your score may be lowered if you open too many new accounts all at once. This implies that you have debt or are ready to acquire more. Opening a lot of credit accounts quickly can make you more vulnerable to debt, especially for those without a long credit history. Every application you make for a new line of credit counts as an injury or a hard hit. There may be several inquiries when you rate shop for a mortgage or an auto loan. These inquiries, however, count as a single hard hit in each 14-day period because you only have an application for one loan. In contrast, making many credit card applications quickly will result in repeated hard knocks and could harm your credit score. Your credit score won't be impacted by soft hits, such as requests for your credit report from you personally, requests for lenders to extend you pre-approved credit offers, or requests from employers. What actions may you do to raise your credit rating? Pay your bills on time. Making all of your payments on time is the most crucial action you can do. Your credit score may suffer significantly as a result of late payments. Additionally, you ought to strive to maintain a low credit utilization rate, ideally under 30% of your available credit. Also, it's crucial to refrain from applying for too much new credit at once, as this can lower your rating. In conclusion, managing your finances effectively requires that you have a solid understanding of credit scores. You may position yourself for success by monitoring your credit score and taking action to increase it. Maintain open accounts. It is uncommon for closing a credit card to raise your credit score. Make sure that closing an account won't harm your credit at the very least before doing so. You might be tempted to cancel credit card accounts that are overdue, but the balance will remain on your credit record until it is paid in full. It is advisable to keep the account open and make on-time payments each month to reduce the balance. Since credit history duration accounts for 15% of your credit score, canceling a card with no debt can still lower your score. Generally speaking, your credit score will rise the longer you keep your account open. Set up automated payments, even for the smallest amount, for a student loan debtors expressly to ensure that due dates are never missed. This function is present in most billing platforms. Your payment history accounts for 35% of your credit score and is the main determinant in the Vantage Score and FICO scoring models. Become an authorized user. Your credit score can rise if you are made an authorized user of someone else's credit card account. The payment history of any credit account for which you are an authorized user can be found on your credit report. Your credit score can go up if your payment history is good. However, if the account holder doesn't make timely bill payments, this tactic could fail. If the principal account holder doesn't make timely payments, both your credit report and theirs will include these missed payments. You should also confirm that the cardholder with whom you intend to collaborate does not have a high credit use percentage. Diminish your debt-to-income ratio. A personal financial metric known as your debt-to-income ratio, or DTI, compares the monthly debt payment to your gross monthly income. Lenders use it as one criterion to assess your capacity to budget your monthly income and make debt payments. Your DTI is calculated by dividing your total monthly recurring debt by your monthly income. Lenders and creditors can see that you have a healthy balance between the amount of debt you are carrying and your income if you have a low debt-to-income ratio. However, a larger debt-to-income ratio may indicate that you have more debt than your income can bear. It increases the danger of lending to you. Most people's lives require them to borrow money and maintain good credit. It is crucial to have a strong credit history and keep a high credit score because both can significantly affect your overall financial situation, both now and in the future. At Upgraded Points, we provide a wealth of credit-related information as well as advice on how to build and maintain a strong credit report. We also offer evaluations of a wide range of credit cards so that you can decide which might be the finest choice for you. Thanks for being to the end of the video. Don't forget to like, share, subscribe, and tell us what you think about this video below in the comment section. Thanks for watching, and we'll see you in the next video.